Okay,
Yep.
welcome everybody. Today we are going to talk about different ways of creating tax-free income during retirement. And today, your hosts are Karen Koenig with KK Financial Solutions, that's me, and Becky Porter with NAF, is it Reverse Mortgages or what is it?
Yeah, or really, I know they say NAF reverse. NAF stands for NAF or New American Funding.
New American Funding. And basically, what we're going to do, I'm going to talk about six different topics or six different ways that you can create tax-free income. And then we're going to go into one of those topics, and the other five, we will get into those in different different video or different webinars in a series of webinars that we're going to be doing together. So today I'm going to start with these five different topics of ways that you can increase or get tax-free income during retirement. And the first one is you can leverage accounts like Roth IRAs and HSAs. And Roth IRAs, for all intents and purposes for 2024 and 2025, for up to age 50, you can do or put into your Roth IRAs up to $7,000. And if you're over age 50, you can put an additional $1,000 into it for a total of $8,000. And why is that? Is because Roth IRAs are tax free as long as you have owned them for 5 years or longer. Any of the gains or anything that's inside of a Roth IRA is almost just like a savings account. So when you take the money out, it is tax free. And then HSAs, those are health savings accounts. Those are also tax free, another tax free way of getting income. And for single people, you can put up to $4,300 into those in 2025. And if you are a family, you can put up to $8,500 into an HSA in 2025. So that's another way that you can put tax-free income. And those are also, HSAs are also tax deductible. So you'll hear your CPAs ask you, did you put anything into your HSA this year? So those are really good ways of savings for your taxes as well. Another way to increase tax-free income is using municipal bonds. And you've probably heard about them. The acronym is muni bonds. Those are usually state or local type bonds. Let's say a local municipality, let's say the state or the city of Mukilteo or the city of Surprise or the city of Phoenix is going to, let's say, build a road, or they're going to um, build a new school or something like that. They'll issue a municipal bond. And you purchase that and you buy into that. And what that does for you is usually the interest that you incur on a municipal bond is federally tax exempt. So you won't pay any taxes on it. So that's another way that you can get tax-free income. Another one is making QDCs. And what is a QDC? That's a qualified charitable distribution. Actually, it should have been a QCD. They're backwards. And a qualified distribution, that would be a distribution from your IRA. So usually high net worth people, or even if you're not high net worth and you don't need your RMD for the year, and it's not something that you necessarily need to take or need the income for the year, you can make a qualified charitable distribution of up to $108,000 each year. And what that is it's actually excluded from your taxable income when it comes time to file taxes. So that's another way that you can, because usually when you do an RMD, that's taxable. So because that's a tax deferred in your IRA, and when you go to take the RMD, that's added to your income and it's taxable. But if you do a QCD, then it's not taxable. So a lot of people don't know about those. And then, or you can do strategic withdrawals. And what do I mean by that? That means taking money out of your taxable accounts first. So you would want to do a withdrawal out of an RMD account first, or if you wanted to take something or taxable account, sorry, it would be like your like a brokerage account where you're taxed on your gains and those types of things first, because you would want to have your um, tax deferred accounts continue to grow. So there's a way to start taking withdrawals out of different accounts that you have to maximize paying taxes or not paying taxes. And then another way that you can increase tax-free income during retirement is using permanent life insurance. And one of those is you can withdraw against the basis of the permanent life insurance. And what does that mean? That just means that that's taking money against the total premiums paid. So you can take withdrawals against the total premium paid, or you've heard people where they can borrow or take a loan against their earnings tax-free on a permanent life insurance. And then the last thing or ways to increase tax-free income is using home equity or using the equity in your home. And that's why we have Becky on today, is because she's going to go into a really good way of using your home equity. So I'm going to go ahead and turn it over to Becky, and she's going to talk about that.
Great. Well, welcome everybody. Thanks again for taking time out of your day to listen to Karen and I. And hopefully this will bring some good information for you guys. And, you can wrap around with us and we can get into a little bit more detail of whatever your situation is, because obviously everything is very strategic for your situation. So like Karen said, today we're going to look at home equity and using home equity in retirement. And if you're going to take withdrawals from that, believe it or not, it is tax-free. So that's a great way to make your other assets that you might have with Karen even last longer, doing it in a strategic way. Go ahead, next slide. So we're going to look at these 8 areas, the agenda, a reverse mortgage, and what do you need to know? So don't be afraid when you hear the word reverse. I know the old reverse mortgages had a lot of negative connotations about them, and they've changed a lot. So we're going to go through here and talk about, is it right for you? How does it work? Using other liquidity options out of your home, and examples of some case studies of some personal people that I've actually helped, and the missing misconceptions, and how does the process work, and why use New American Funding when doing this. So let's take a step back, and how do you picture your retirement? Maybe you're not in retirement yet, but you're on your 5-year plan to get there. So what does that look like? Because now is the time really to be planning. And if you're in retirement and you haven't gone through all these steps, that's okay too. So it's time to, reel back a little bit then and look at what you're doing, and is it working for you, and can you create more income that is tax-free? So taking a look, writing out those goals, what do you want? Do you want to cruise all the time? Do you want to take family, pay for kids' college? At New American Funding, we have the fun little thing of retiring like a boss. And that really is, if you think about it, right? We want to live in our retirement years, not exist. So how do you want to live? Go ahead, next slide. So what do you need to know about reverse mortgages? We can go ahead and skip past that one. So I think this is important for people to understand a little bit of the history. I think a lot of people don't realize that the first reverse mortgage was clear back in 1961, and it was for a woman out of New York who lost her husband and she was going to lose her house. So that was the very first reverse mortgage that was done. And there was a lot of predatory kind of lending after that, where people would, loop in with financial advisors, with estate attorneys, and they would really, corner that senior into removing a lot of money, and then they would invest a ton of it and lose it all, or they would have them spending it on lavish, estate plans maybe that they didn't necessarily need. So that's when the Housing Act and the government stepped in 1987 and put, and that's mainly FHA, and put some real guidelines and protection in. They still needed some improvements. There was improvement along the way. So that's actually FHA insured it in 89. So that was a big step. But really, our biggest changes happened just about, I want to say it was 2015, so not that long ago. And it was really revamped to put a lot of protection in for mainly borrowers if they had a spouse that was younger. That was the largest. They also lowered actually the lending limit, which is good and not so good. People actually get mad because we won't lend them more money. But just know that a lot of protection has been put into place for the senior, and we'll go through and you'll learn more about it. So they're looking out for you. It being slow to advance. So who qualifies? This is the biggest question, because people learn about the reverse. They're like, oh, I want to do it. And they're in their late 40s, early 50s. So with the HECM, which is the home equity conversion mortgage, that one in particular, you need to be 62 years old. And in some states, you can be 55 if it's a different program. And the non-borrowing spouses, if you do have a younger spouse, can still reside in the home forever. There just won't be on the loan. Many years ago, we would actually remove them off title, and that's where it led to some big problems later down. And you heard those negative things in the news about, oh, the widow loses the home, and that stuff can't happen anymore. You do need to reside in the home as your primary residence. That's really important. You do sign once a year an affidavit that states you are still living there as your primary. Doesn't mean that you can't have a second home somewhere. You just need to live in your home with the reverse one day longer, right? And they also require you to do counseling. People freak out and they hear counseling, credit counseling. I have good credit. What do I need to do that for? It's a third-party company that is just going to go through and they're going to make sure you understand how the loan program works. They don't qualify you or anything like that. It's a half-hour phone call approximately. And again, they're just going through how the loan program works. Then we also make sure that you can actually pay your property tax and insurance. Years ago, they'd pretty much just give you the loan. And that always wasn't the best, because maybe people still had restrictive income and they didn't have enough money to cover those property taxes and insurance. Then they would get foreclosed on. And that's not a good thing. So we do make sure that you can pay for your taxes and insurance. So we look at what's called a residual income, and it calculates out even your square footage of your home and what approximate utilities might be, because we don't want to put anybody in a situation that's not good long term. So here's the basics. Similar to a line of credit, that is the way I like to look at the HECM, which is the home equity conversion mortgage, which is the FHA product and the most popular type of reverse mortgage. It's definitely easiest to look at it like one big line of credit. That is the reverse mortgage, where you do need to have one borrower at least 62 years old. There are non-FHA, which we consider those a jumbo or a proprietary product. Those can, in some states, go down to age 55. In the state of Washington, where I'm at, it's age 60. And I am licensed in multiple states, but here in Washington, it's 55. A lot of people don't realize that you can also purchase with a reverse mortgage. So it's not just for the house that you're in. Maybe you want to downsize, right, and keep a bunch of money extra in the bank, or you're just not going to net enough from your proceeds. And you're like, how am I going to go buy something else? Prices are so up there and expensive. So you can do a reverse for purchase. And it needs to be real property. So we can do manufactured homes in parks if you own the land. So I have done a purchase like that. It could be on a manufactured home on 5 acres, but you must own the land. So we consider that real property. The amounts that you have drawn out are going to accrue interest. So I think that's important to understand. And we go over that a lot. And then the repayment. People always want to know, well, there's no payment. Payments aren't required. You can make a payment. And in some ways, that is the best for your situation. And that's why it's important that we sit down and find out what your needs and goals are. And do your kids want the house, and strategically come up with a plan? But there are no payments that are required. And so when you decide no longer, or you're no longer gracing the earth with your presence, that is when the loan gets paid back within a year after that. Go ahead and next slide. So again, who's eligible? We went over a little bit of that you need to be 62 or older for the home equity conversion mortgage. You do need to be a U.S. citizen or a lawful permanent resident. Again, occupy the property, receive that counseling, and make sure that you can pay those taxes and insurance. The types of property, we hit a little bit that we could do manufactured. You can also do multi-family homes. So a 2 to a 4 unit complex, right? Or a unit, 2 to 4 unit, which can really generate some income if you're not afraid to be a landlord, right? You could always have a company manage those other units, but it's a way to generate income. So maybe you're going to go buy a fourplex or a duplex, and you're going to live in one side of it and rent the other out, and that's going to generate more income for you. So that's a great way to work it. And FHA approved condominiums. So a lot of seniors want to live, in a smaller footprint, or maybe they want just the whole house maintained. There are single family resident condominiums where some of the HOAs take care of the full outside of the house, but they need to be FHA approved to be on the HECM product. So if they're not FHA approved, we would put you on the proprietary product. Go ahead, next slide. So how does the reverse mortgage work? I mentioned that you don't have to make a monthly payment. You can. And again, strategically, that might make more sense. It's easiest, again, to look at it as one big line of credit. If you do a purchase, you're going to usually max out that line of credit. If you're in your current home and you have a lot of equity, then that line of credit, you may use just a little bit to pay off your current loan, or maybe you have no balance, and so they're going to give you a large line of credit. And maybe you need to draw a chunk out to do some home improvements, to make it wheelchair accessible, or maybe you're just going to let that line of credit sit there and you're going to draw out a little bit to pay, like property taxes, go on your yearly big vacation, things like that. But whatever you have drawn out, that's going to start accruing the interest on it. So that's basically how it works. And you can live in your home as long as it's your primary residence. Now, if you end up maybe later on down later in the years, you end up having an injury and you need to go to rehab, they're not going to make you pay off the loan until you're no longer coming back after a year. So they're going to give you time. They really do work with you. So unlocking retirement security, right? This program was put into place to allow the senior to age in place. I'm sure many of you have heard, oh, they're house rich, cash poor, right? All of your money's buried in the walls. I'm sure everybody can agree that you could use some extra income during retirement. And if you've got a house payment, that can really get into some tight, monthly cash flow if you've got that big payment and taxes going out. So it's designed for people to age in place, to maintain that independence. Maybe you're going to use that line of credit just to help a gardener come in, help a cleaning person coming in. So you can eliminate, if you do have a current payment, eliminate to give you more cash flow. There's lots of reasons why we're going to put this into place, but it's going to give you more security and control of your funds. And I think that's what's most important during retirement. It's all about cash flow, right? Karen's helped you climb the mountain of saving all that money. Now we're together going to come up with a plan of how to make those funds last and create some more cash flow for you. Next slide. Nope, I think it jumped to a bunch of them, huh? I think it's going to go back quite a few. Okay, we did that one. Okay, so other liquidity options, you could just head right to the next one. So there's other ways, right, to get into your home equity. And we go over that when I sit down with you. One, you could sell your house, right? You could just sell it and go rent. That may or may not make sense for you. Obviously, if you do that, you're not going to have a growing asset anymore. And I think that is important. But you can do a regular refinance and cash out, but that's going to also create another payment and even a bigger payment. So maybe not the best. You can go to the bank and get a regular HELOC. With that, you're going to still have payments required. Usually, you only have a 10-year draw period. And after 10 years, it turns into a 20-year amortized loan. So I think that's really kind of a bad band-aid for a lot of seniors if you're on a fixed income, because you're going to get further down the road, everything gets more expensive, and then you're going to have this huge, either a balloon payment, which I've been helping a few seniors get out of right now, or you're going to have that big 20-year loan, which is going to just be more expensive than what you have today. So I don't think that's the best solution. And again, doing like a cash out, doing a 15, 30-year mortgage, you still have those big payments. So the feature, with the home equity conversion mortgage, payments again are optional. You're still going to own your home. We'll go over that later. And the biggest piece that people don't understand, we can do a whole separate seminar on it, is the unused portion of that line of credit is going to grow and compound. So let me give you an example. Let's say you qualify for a $200,000 line of credit. You only need 25,000 out of that at closing for some home repairs. So the 25,000 plus all the loan costs are going to be what your current balance is, and that's going to be accruing interest, right? So it's going to be getting bigger if you're not making a payment. But the rest of that 150,000 that you're not using is going to grow. They're going to add a little bit more equity every year that you can draw out from. And right now, those are growing and compounding by about 6.5%. And it's guaranteed and backed by HUD. Even if your house value crashes, we go through another crash, they're going to guarantee that line of credit, and they're going to guarantee that it grows. So that to me is amazing. That is I think the best piece of the whole entire home equity conversion mortgage. Because what do we need when we're seniors? And maybe we're going to get this loan when we're in our early 60s and we don't really need the cash flow. Maybe we're still working, but we're going to get that line of credit and just let it sit there and grow. And I've calculated out, and we can do that for you, approximately of what you're going to have. In many cases, that person that with a $250,000 line of credit, by the time they're 90, you've got $1 million to work with. So if you're wanting to age in place and bring caregivers in and not go somewhere, this is a really good viable tool to do that, and much less expensive than paying for long-term care insurance that's going to dictate how you use those funds. So it's a non-recourse loan, meaning that they can't come after your other assets. So that's huge, right? If you're wanting to leave stuff for your heirs and you're going to mainly focus spending down on the home, again, we will structure it as to how it's going to work best for your situation. Go ahead, next slide. So we're into some case studies here with this particular couple, right? So it gives you the example. They have a $1.1 million house. They do have a remaining mortgage of $300,000. And just for a little teaser fact here, about 65% of all retirees still have mortgage payments. So I use sometimes my mom as an example. They have a mortgage payment. They could pay it off, but some people don't have that ability. But if you're wanting to be able to travel more and you're feeling strapped with that, oh my goodness, go live life, go live life. Don't be strapped down by a big house payment. So in their case, $2,000 a month, which is pretty reasonable compared to rent at some places, but still that's a chunk of money, $24,000 a year. And if they've only got income maybe of, 65, 70,000, that's a large chunk of it. And in this case, they're 64 years old. So it's a calculation as to how much we're going to, the proceeds that you're going to get. In their case, it's just shy of 340,000. Plus they're going to get 24,000 more cash flow just because they don't have that mortgage payment. And they could draw 40,000 out at closing for other home repairs or whatever. They don't have to draw it out, but that's what would be available at that time. So that just opens a lot of doors for them. And it's telling you at the bottom what the expected rate would be. So these slides were done a little bit ago. Rates are actually, a little bit lower. Our margins are lower. And obviously that changes as time goes, and we'll look at your situation. Go ahead and go to the next slide. Give you another one. Here's where some people will use this program for long-term care. The house value only $500,000. They only have a $50,000 lien, so they pay all that off. Available proceeds $166,000. Now, some people will literally just there's multiple ways that you can use the funds. Some people will take just a flat lump sum at closing. Some people will want the 10-year payment. That is a guaranteed payment for the rest of your life. Even if the value of your home is all used up, they will continue to give you those funds. Or you can do a term payment, or you can just have it on that line of credit. Personally, I kind of like the line of credit because it's going to grow and continue to grow if you're not going to be using it, and you can tap into it later. If you're on that 10-year payment and you have a heater system go in your house, how are you going to pay for it? You can set up payments, but I think having that line of credit grow over time and then being able to take a lump sum out, for me, I think I'm more comfortable with that. Everybody is different. You can have a combination of things. So we'll look and see, where your situation is at. Some people will literally just use the funds to bring somebody into their home, again, for cleaning and caregiving. Some people will use these funds and actually go purchase a long-term care policy, maybe through Karen, and then use the funds on a monthly basis out of their line of credit. So they'll have the line of credit going and paying for a long-term care policy. Everybody's different. So it's whatever's going to work for you. I'll share a couple of real life situations that I've helped clients. Multiple, I mentioned the reverse for purchase, done a handful of those, just closed on one where she was downsizing and needed to be bought out. She owned a property with a significant other, right? Just more of like a roommate. They weren't married. And again, housing costs have gone up so much and she couldn't pay cash for anything. She would have ended up possibly just renting, and then she would have gone through those proceeds probably in about 6 years, and she's still pretty young. So that's not a good situation. So we did a reverse for purchase for her. She used a chunk of her proceeds, about I want to say it was around 250,000 or 270,000 that we used. And then she was able to stash an extra 100,000 in her bank account. And she purchased a property. She'll never have a payment. And she left a huge house payment that the roommate was not even helping to pay anymore. And that's why she needed to get out of there. So that was hand over fist putting her in a better situation. Other clients, their spouse passed away. They wanted to downsize and do nothing but travel. So they bought that home in the manufactured park, but it was on owned land. And believe it or not, it grew enough in value. 5 years later, we were able to do a cash out refi and get him $80,000 more cash because he just wants to travel. So I will tend to follow up with many of my clients and check in with them to make sure maybe they're not blowing all their money in a year, right? We want it to last and help them navigate through some of these situations. Other clients, they're doing okay. They have a decent income, but they're concerned about maybe HOAs going up. One client, so we did her reverse mortgage, and literally 8 months later, she was slapped with a $10,000 assessment. And I'm like, don't worry, you've got money. Praise the Lord, we did a reverse mortgage, so don't worry about it. And I spent time going through her budget, and she was just like, so relieved because she was losing sleep over it, and that's what we don't want. So another recent gal, this is the last one I'll share. She is a little bit older, still working because she's got that house payment, and she was told she's going to lose her job. They're closing down her program, and she was kind of panicking. So she actually had to bring a little bit of cash in. She had to pay off her second mortgage and then bring in just a smidge more cash, a couple thousand at closing. But we were able to eliminate her house payment, and she still's got a chunk in with her financial planner. but she, come December will be unemployed. If she wants to go find a little part-time job, she will, to keep her busy. But she's so relieved that we calculated everything out, went through all of her bills to see, look, you're going to be okay. Even bringing a little bit of cash in, you're going to be okay. Don't go sell off. She was looking at another type of program where you literally sell off a portion of your house to somebody, and they give you a chunk of money. I'm like, you need to think real hard about that, because they're going to literally own 20% of your house, or one of them offered 66%, which is going to really tie her up for never being able to do a reverse. Plus, she would still have her house payment. So she would, they'd give her a lump sum of funds, but then you're going to just use all that up paying your payment, and she's still going to be in a bad situation. So she is just very relieved that we were able to get the loan done for her, and now she can retire and not have to worry about it. I'll let you go ahead and go on. And if there's other scenarios, we can just kind of flip through those and get to the misconceptions here and myths. So the biggest myth is a couple of them, that only people get this loan if they're in really strapped, right? I've just given you a couple examples where they kind of weren't, and where they were, they really needed the money. So many people use this for creative financing these days, helping your other assets last longer. Because if you do have some assets with Karen, and maybe the market's plummeting because you're not ready to move them over to total safety, so some are still in the market, and the market crashes, you don't want to be taking money out at that time, because the sequence of return, you're gonna have to have the market come back a lot more because you took money out as well. So that's when the reverse mortgage could come in. And if you use it just for that strategy alone, you're probably only going to be using the reverse mortgage maybe 3 times in your whole retirement. But that other money that you have invested can rebound and grow. Go ahead next. And that you have to have your home paid off, right? I just mentioned in a couple of scenarios will be paid off their loan. Go ahead, next one. And again, always remembering that you have to pay your taxes, your insurance, and any HOA fees. So this is the time of year I'll be this next week reminding all my clients to please don't forget to pay your taxes. I would feel really bad if they would forget, and 3 years down the road, they're getting foreclosed on. That would be terrible. I would say this is actually one of the biggest myths right here, is that the bank owns your home, and they don't. I just had a gal I was sitting down with, and her friend was with her. She's like, but doesn't the bank own your house? No, the bank does not own your home. And when you pass away, the bank does not take your house. So the loan would need to get paid off, and your heirs have a couple of choices. They can either just sell the house and pay it off. They'll take the rest. If they want to refinance it and pay off the loan balance and move in themselves or rent it, whatever they want, they can do that. Was what they're talking about here in the last sentence, that their heirs have the option to purchase the home at 95% of the appraised value. That is when, if the house crashes, right, and it's underwater, they have the first right of refusal to purchase that house for 95% of the value. So they are able to do that before it hits the market. So there are some choices, and the servicer will work with the family. If you call them, the heirs call, and they say, my loved one's passed away. Yes, they are going to serve you papers that state you need to put the house up for sale, but you can indeed, they know you're working through stuff, right? There's probate, you got to clean the house out. It's a stressful time. So you're going to need to just let them know what's going on, and they can give you a 6-month extension, and they can do that twice. After a year, something needs to be done, right? The investors are going to finally want their money, because remember, no payments are being made, right? They're not getting any of their interest until the person is no longer living in the home and the house gets sold and the loan gets paid off. And I already mentioned this earlier too, about restrictions. There are no restrictions on how you use the funds. You can spend it on whatever you want. So there's people who take their whole family out to a world cruise, right? There, you can spend it however you want. But I do say spend it wisely, because you never know what's coming ahead, what lies in the future. Next. And how the process works. You talk to me, we go over your whole scenario, find out, is this something really for you? And you're going to go to counseling. and then apply and get approved. Those kind of 2 and 3 kind of happen at the same time. Some states you cannot actually sign the application until that counseling certificate is in. And other states you can sign it. We just can't fully turn it into underwriting until we have the actual counseling certificate. And then it goes through underwriting and appraisal ordered and things like that. It's much easier to qualify because, again, you're only qualifying with the property tax and insurance, HOA, and whatever other bills that are on your credit report. And then we're off to funding. We can usually fund these within 30 days. 60% of all of our loans at New American Funding actually fund within less than 30 days, which is pretty remarkable for reverse mortgages. Next slide. And is it right for you? So I can send you this information if you leave your email. I think this is important, to ask yourself these questions. Is it right for you, and why? Why are you wanting this? What do you want retirement to look like, right? I think the biggest question is further down on here is, how do you expect to fund the unexpected, right? It could be medical. It could be something going wrong with the home that costs a lot. How are you wanting to fund those? And do you want to leave something for the children? Maybe you want to start leaving money every month, every year for them now, and then this loan can provide that. So do you want to stay in your home? Do you want to sell your home and downsize or right size? So asking yourself a lot of questions. I'm happy to go through and sit down with you and have these conversations and helping you work through those and finding out, how do you want to spend this most awesome chapter of your next life, right? We're not supposed to be stressed. And it's unfortunate that 80% of seniors lay awake at night wondering if they're going to be able to make it. We're supposed to be living our life to the fullest and not be worried. So people are usually really surprised when we go through the numbers about how much money that they will have at the end of a reverse that they still can leave to their children. So again, every situation is very different, and talking through it and running the numbers and seeing how it works for you is the best thing to do, and talk through it. And if it's not for you, I'm going to certainly tell you. And, I know lots of other people, and there's lots of creative ways to make retirement happy.
And these are a lot of the same questions that I ask my clients. So,
Mm-hmm.
and I can pass these questions on, or answers on, to Becky as well.
Yeah. So that's what's great, and why Karen and I work together, because we're going to have you at your best interest. And when we're working together in your benefit, you've got two people helping you, go through this, and she can crunch numbers and I crunch numbers and come together and find out the best solution for you. So, and again, why NAF? Why New American Funding? I mentioned how we close loans quickly. 60% of them get closed within less than 30 days. On the reverse for purchase, we actually were able to close the loan a whole entire week ahead of time. So we'll get it done. And clients come first. I don't care what company I'm at. All my clients always come first. That's what's most important to me. But we've got our staff alone has so much experience in the business, and a lot of caring people. I will say it's probably the company I've worked with that has the most caring people, and the knowledge that comes behind that. And, being a top rated company, one of the largest reverse mortgage companies in the nation, we can place loans with many different investors. So it's kind of like what a broker used to be. But so we fund the loans, and they're serviced by somebody else in the reverse world. It's not a huge amount of players in that arena, but we are ranked very high with the different investors, and they're very excited to see how much New American Funding is growing. So that's always good to hear that feedback, that they will do anything to help us grow, because they know that we're a good company. Go ahead. And I think that's probably the last slide. So reach out to me and, Karen, and we can sit down and help you, comb through your next chapter of your life. So excited to see how that works out for you.
Yeah. And
want to add anything?
no, just thank you everyone for being on the webinar today. And like I was said, this is going to be one of many of a series of webinars that we're going to be doing. And hopefully you guys will be on the other webinars, and we're going to be posting these as a series. So if you miss any of these, or you weren't able to attend this one, you'll have it up on wherever we decide to put this. We haven't decided where we're going to put it up, but
Yeah.
uh,
Yeah, I do have a YouTube channel that I am working
that's
on
it. We're
that
going to
will
put it
be
on
coming out.
YouTube.
Yep,
We're going to
yep,
put it up on YouTube, and we're going to have a series of webinars to for people to experience. So thank you, and thanks for attending.
yep. Have a great day.
Have a great day, everybody.